people, when you ask them to part with their hard-earned dollars, their first reaction is, why are you trying to scam me? What are you going to do with my money?
Yeah,
I'm
is it a
never going to get
scam?
it back.
Yeah.
And I love to contrast that with political giving, because it just seems so easy in the current times that we live in for people to raise money for political candidates where they're getting a 0% return and a guaranteed 100% loss of capital. And yet people part with it.
Yeah.
But something psychologically, when I come to them and I say, hey guys, I've been doing this for almost 20 years, and we have a great track record of delivering 20% returns on people's invested capital. And the first thing they look at me, they're like, whoa, man, what, are you trying to scam me, bro? All right, guys, we are back with how to invest in CRE.com. It's been a little while. Congrats to my man, Braden, who just had his third child.
Yes.
Congratulations.
He's been at the house doing dad duty and helping out his beautiful wife, getting settled with all three kiddos. But we are back today. And the topic today, we're going to be going over some of your most frequently asked questions. Brian, why are we doing that?
Well, we're doing that because whenever we ask someone to give us some money, they are a little apprehensive. They don't want to part with their money. And so they always have a bunch of questions for us. And we decided we'd go ahead and answer those today.
Yeah, I mean, it's kind of your duty, when you go to give somebody a large sum of money, and, right now, average check size could be well north of $100,000. So when you're thinking about, that potential amount of money, they're going to ask you a few questions. It's like buying a house. It's, typically a massive purchase. And they want to understand how it works, at least at a high level, so they can come home, tell their partner, tell their spouse, know how it works, sleep better at night, everything like that. Makes sense.
It's so interesting to me. We've talked about it before. People, when you ask them to part with their hard-earned dollars, their first reaction is, why are you trying to scam me? What are you going to do with my money?
Yeah,
I'm
is it a
never going to get
scam?
it back.
Yeah.
And I love to contrast that with political giving, because it just seems so easy in the current times that we live in for people to raise money for political candidates where they're getting a 0% return and a guaranteed 100% loss of capital. And yet people part with it.
Yeah.
But something psychologically, when I come to them and I say, hey guys, I've been doing this for almost 20 years, and we have a great track record of delivering 20% returns on people's invested capital. And the first thing they look at me, they're like, whoa, man, are you trying to scam me, bro?
Yeah, where's the catch?
And I'm thinking, what are you talking about?
Yeah.
But that's the reality of it. When we go to try to make our investors money, they're going to be more skeptical of us than if we just ask them to support our nonprofit or our political cause, and they'll say, hey, Joel, here's the money, go do with it what you want, because they're making a decision that it's gone. Yeah. But as soon as there's an expectation of return, then you've got to put them at ease that you're going to actually perform.
Yep.
Yeah, I mean, I'll just start it off here. One of the first ones I get typically every single time is, what the heck am I investing in? Like, what is it? Is it a REIT, or is it a partnership? How does this work? Is it like tenants in common? Are we joint tenants? How does this work?
I'm not sure most investors are going to know what exactly joint tenants are versus tenants in common, but
went a little too far on that one. Yeah.
To put it as simply as possible, you are buying shares in a company that's going to actually own real estate. So this LLC, limited liability company, is going to own property, and you're going to actually have ownership shares in that company. So it's real ownership in property.
So give me some quick pros and cons on the difference between a REIT and direct investing in an LLC that actually owns the real estate.
Okay.
I mean, what's the biggest?
Okay, well, I don't know the negatives of a REIT, so you'll have to handle that.
What's the benefit?
The benefit of direct ownership is all the tax advantages that you get; those get all passed down through. All the profits; those are passed down through. So essentially, you're investing in a company, and all the advantages that come with that, you get to participate in all those.
Exactly. So the biggest downfall with a REIT is that you're not investing in real estate. You're investing in a company that owns a bunch of real estate, and they're legally mandated to distribute 90% of their profits. Mm-hmm. That's a REIT. You don't get a lot of the tax advantages like depreciation, which is a massive one. And that's huge. That's one of the biggest reasons to invest in commercial real estate, is to kind of shelter some of that passive income you get.
Mm-hmm.
Yeah, I agree.
I didn't know you didn't get that in a REIT. I've never invested in a REIT, so I don't know.
Well,
Glad I didn't.
Yeah, compared to direct investing in real estate, REITs kind of suck.
Yeah.
Okay, so now that they know what they're investing in, the next thing they're going to ask is, well, how much money do I need to invest? That's typically,
I do get that a lot. Yeah.
They don't know, is there a $500,000 minimum? Maybe they've got 25,000. Is that enough? You guys not taking people of that size? So Braden, with Criterion, what are you telling them?
Yeah, so our minimum at Criterion is a $25,000 investment, and that's just the minimum to get in the door. You can do any number above that, but the minimum investor is $25,000.
So at Precision Equity, we've done a minimum of 50 before. Now we typically try to do a minimum of 25 because we want to get people participating. Because if we can get them familiar with investing in real estate, chances are we're going to make them money and they're going to come back over and over, and I get them in the game. And some people, if you put a too high minimum, they're not going to be able to pull the trigger. So we've essentially lowered to 25. I guess every deal is different, but
yeah. And the reason why people set their minimums higher is to not just get more money out of you. It's the burden of investors.
All the paperwork and
the paperwork. Our last stack of paperwork for the Criterion building in Owasso was 102 pages. 102 pages, and you don't have to read every page and fill in every page, and it's a lot of paperwork. You have to file a K-1 for that person. You have to handle their tax problems. You have to answer their phone calls. You have to. I mean, it's a decent amount of work. Of having 50 investors versus 10 investors on the same deal, I'd rather have 10.
Yeah, you got to limit the number of investors to keep all those costs down, really.
Yeah, but at the same time, it's such a high barrier to entry. A lot of people can't go buy an apartment complex. Last apartment complex I looked at was $39 million. And I mean, that's shocked the crap out of me because it was so expensive. But it's the general idea of you're aggregating a ton of people's money together to go and buy this, because that's more beneficial. You get a nicer property.
So part of the pitch is for our investors is they may have 100,000 or 200,000, and do they want to put that all down in their first commercial deal and try to figure that out? Well, if they're investing with us or with one of these companies that we own, now they can spread that 200,000 over 8 deals. Now they get some diversification, maybe over even different asset classes, different states, and they're with a group that has a proven track record versus betting all of that on their first commercial deal. More risk and more work. So it's pretty appealing to most people.
Okay.
Yeah, going back to diversification, you also have, in addition to the states and asset classes, you've got different timings of allocating the money into the market. You've got all of the different paybacks. Some might not be paying cash flow. There'll be a development or a lump sum at the end. Some may be paying quarterly cash flow. And it's just the idea that you should try to be in on almost every single deal is kind of what I say. Like,
Yep.
Let's get an amount that you can kind of do quarterly or maybe once or twice a year.
I would say a lot of our investors do invest in most offerings just to get their investment diversified. So they've invested, they know they're buying ownership shares in a company that's going to own real estate. What is the payback schedule and how do you pay that back?
Yeah, that's a great question. Another question is, how do you initially get the money too? Is it check? Is it wire? Both of those. And then payback is different. You're going to have some different time frames. I mean, we've got a couple different time frame of deals right now. And I mean, all different types of deals have a different payback period.
Yeah. If we're just buying some cash flow, then it's typically quarterly dividends. But like you said, sometimes we do some other development projects where we're not going to realize cash flow at first. And so that's more of sometimes it's a buy and hold, but sometimes it's a buy and resell quickly and just it's one lump sum check at the end of the deal.
Exactly.
Might just be 18 to 24 months.
All that's going to be outlined up front. I would say majority of Precision Equity deals have been cash flow producing deals. So let's say we close in August. We're probably paying a prorated dividend at the beginning of October for that third quarter. Maybe it's half of a distribution. If we planned on paying 12% annually, then quarterly it's 3%. Maybe they get 1.5 points for that first quarter.
Yeah.
But generally, we're trying to pay quarterly distributions in
Starting
line with what we
quarter
projected when
after
we
the
pitched the
purchase.
deal.
Yeah. Okay, so so can everybody invest in every deal? Are there any? Sometimes we've done some deals where you have to be a accredited investor, and so what does that mean?
Yeah, so there's two main buckets that I want to focus on for the purpose of this question. There's a lot more levels of sophistication when it comes to being an investor. You can be a qualified investor, you can be a qualified purchaser, you can be a bunch of different things. But the two I want to focus on is sophisticated and accredited. So sophisticated means you're not a millionaire and you don't make $200,000 a year. Accredited means you're a millionaire, excluding your personal home, and you make $200,000 a year, or you and your spouse jointly make $300,000 a year, and boom, you're an accredited investor. And really, what the SEC is just trying to protect is the blue collar worker. A lot of regulation comes down to like residential real estate, and a lot of the consumer they want to protect from being defrauded. Whereas when you start to get to be a sophisticated investor and a millionaire and that sort of annual income amount, it's a higher level of sophistication, and you've started to amass enough wealth to where you're typically investing it in other places outside of yourself. So you become more comfortable, more aware of the term and the jargon, and you may have an attorney, you may have a CPA. You've got more behind you than just, you can't go out to Walmart and hold a sign that says, I'll take your money, if you can be an accredited investor.
Yeah, I think the important thing is people that have $1 million net worth or make $300,000 a year, they can afford to lose some amount of money of that and still be okay. Yeah. And also, like you said, they have access to professionals that can give them guidance, education, information, where the average person that is a blue collar worker that works hard for their money but just doesn't have a lot of spare money, they don't want people like us trying to take advantage of those people, getting their only $5,000 life savings and putting that at risk. And so that's really the difference between accredited, which can invest in anything, and the normal person that is not really, these investments aren't geared toward that person. Mm-hmm. Sophistication, it's kind of an in-between where they're educated, they can prove some familiarity with investing. Maybe they have a relationship with you.
And they have to sign a disclaimer typically saying they acknowledge the risks.
They acknowledge the risk. They understand what they're getting themselves into. And so that's really an in-between step. And our investments, you can only have a certain number of those. You can't do all sophisticated investors. You need to have some accredited and some sophisticated. But that's another show probably.
Yeah, so the black and white is if you're advertising. Like if you're advertising, if you have a billboard, if you have a Facebook campaign, if you're advertising to people you don't know, you can't take sophisticated people's money. Yeah. They have to be a millionaire. If you see an advertisement on Facebook, hey, invest in this deal. It's got to be for the deal, which is, kind of an important point, because they can advertise themselves as sponsors on general deals all they want. They can't advertise a specific offer. Yeah. Anyway,
we'll keep going.
Yeah. So what I was going to say is, okay, so now I've gotten paid and by you guys, and so it comes up to the end of the year. What am I going to get for my taxes? And also the big question I get is, why did you guys send me $10,000 during the year, but now my tax form that I get, the K-1, has a loss on it? And why is that, and how does that benefit me?
First of all, you get a K-1 because you're investing in a partnership, and a partnership distributes K-1s.
It's just the form's called a K-1, and it literally just pass through right to your personal return.
Mm-hmm. Through an LLC. Yeah, it's an LLC taxed as a partnership. So
it reports profit and loss?
Correct.
Okay.
Yep, and depreciation is written off as a loss. You pay it back when you sell the property, and you pay the tax at that point. But today you get to write it off, which is a massive tax advantage. So like you said, you could potentially get distributed, $1,000 every month. Maybe you got $12,000 that year in distributions, and you get your K-1 and it says you lost $15,000. And the first thing you're going to do is you're going to call me up and you're going to say, hey,
I don't understand this.
My capital balance has been reduced. It says I'm losing money. You guys paid me money. I
don't understand
what's going on here?
Yeah.
And we're just going to say, okay, that's from depreciation. We're going to pay this back when we sell. And that's the beauty about investing in commercial real estate, Mr. Smith, is, a lot of these distributions are tax sheltered, especially in the beginning, because accelerated depreciation. And accelerated depreciation right now is just one of those things in the tax code that isn't always there, hasn't always been there, maybe is not always there, but it's this awesome way to just depreciate the crap out of the property really fast.
It's a paper loss because you're saying, hey, this building is worth less this year than it was last year. And so we're going to allow you to take that depreciation up front, offset it versus the income that we gave you. And it just allows you to get that tax-free income or partially tax-free income until we recapture when we sell, and it's recaptured at 25%. So if you're in a high tax bracket and we give you distributions, you're going to save, let's say you're in a 40% tax bracket, plus state and federal, maybe almost 50%, you'd lose half of the money that we gave you. Well, in this case, for the first few years, you're not going to lose any of it, or you lose very little of it. And even when you do recapture, it'll be at half your normal rate. So really good tax advantages, but that's how the K1s are explained, I think.
Okay. So speaking of tax advantages, another question we get a lot is, can I invest using my 401k money?
Yeah, that's a great question.
Is that, so what's the answer? Can people do that? Can they use 401k or IRA money?
Absolutely. It's got to be in a self-directed account. There's tons of them out there now. It's super easy. Reach out. There's one called Custodian Trust Company. I think they're located in Ohio. We have several investors use them. They're great to work with. It's an annual fee thing. You fill out a form and then boom, they send us money from your 401k. We send your distributions back to them because they're the custodian. It's just directed by you. That's why they call it a self-directed account. But yeah, we've helped several investors get those set up and invest with us, and we've gotten great feedback from it.
Mm-hmm.
A couple questions I get frequently is, how much money am I investing in the deal? Like, they're just looking in the eye. Okay, you want 25 grand? Where's your 25 grand, bro? And okay, yeah, we're direct investing as well. We typically are 10 to a third, maybe more, of the money we're trying to raise. So if we're trying to raise $1 million, we're at least investing that $100,000 to $300,000.
Yeah, we're typically the largest investor. Criterion is usually the large, or our own money, our personal money is typically the largest investor, or equal to some of the other couple of largest investors.
It's treated pari passu, which literally is just a fancy word for the same. I just like to say it because it's fun. Pari passu.
Yeah, Precision Equity is also typically the largest investor. I would say some of the best feedback I can give investors on why they should invest with the Criterion Fund or with Precision Equity is we invest a ton of our own capital. We believe in the deal. We are signing on the debt. So that
was my other question.
Yeah, that's was the next one. Yeah. So we're signing on the debt. We're personally guaranteeing the debt, which means that the deal doesn't go well, it's coming back on all of our personal assets. So it's going to give us extra motivation to hang in there, make that deal work, even put personal assets in on the deal in order to get through a rough patch. They like hearing that because we're not walking from the deal in the event there's an issue. And so those are two big things. The other thing I tell people, which is a real benefit, is I'm putting my friends and family and coworkers' money in these deals. Mm-hmm. We're not raising money from people that we don't know, that we've never met. It's really, really important to us that these deals work. And that's got to be a benefit, because I've invested in several online investments. 2 of the first 3 I did have turned out fraudulent.
These are real estate.
Real estate deals getting indicted by the FBI for mishandling investor funds. Several of the other ones are bigger funds. So I thought, well, let's go big with these big companies. Surely they're going to do well.
Yeah, find like a Fund 4 or something.
Yeah, and they don't. They haven't hit their numbers. Now they haven't. Those haven't lost my money. They haven't been fraudulent, but they have not met their performance standards. Well, they don't care about me or the other people they've met because I invested online through crowdfunding. They don't know us. Mm-hmm. Well, for me, if our deals don't hit our marks, I've got to sit around the table with my friends and family and tell them why, what happened. So it's uncomfortable. So for us, we have to believe in every deal we do before we're going to commit our own funds and before we're going to commit our friends and family's funds. So I think if you're going to invest in these types of deals, get to know your sponsor, get to know their track record, and get to know, previous investors and what kind of experiences have they had. Because I think that's a real valuable tool.
I think so too. And like you said, literally in this group, we have to tell our moms and dads why we lost their money, our brothers and sisters, our uncles and aunts, and our kids why we lost their money. Yeah. Literally. So I don't want to do that. I don't want to do it.
No, I would rather not do it. So if it happens that we have to do that, I want to make sure that I took every precaution. I knew about every risk, and I did my best as a fiduciary to make sure that deal worked.
Yeah. Last one, and then we may be able to call it unless you guys have something else. But why are you doing this? Are you doing this for free? Are you just doing this for me? Are you just doing this to help me out as the investor? Like why as a sponsor? What's kind of in it for you? That's a good question to ask. Most people ask it. How do you get paid? And we've got to disclose this, 2 ways to Tuesday in that 103-page document.
We've gone over this in another podcast. There's so many ways that a syndicator makes money. I mean, there are deals that we have done on our own without investors.
Well, let's focus on the pref. Let's focus on the pref and the benefit of the pref.
Yeah. Well, we take fees up front, but then we pay a pref to the investor. So before the sponsor takes any split of the cash flow, we pay 8% on the invested capital to the investor. It's prorated quarterly. And then only when we exceed that target do we split what's left. And not by split, I mean maybe the investors get 65% of what's left over after 8%, and we take 35% as the sponsor. So the investor has to win first before the sponsor can win.
Right. To the tune of 8%, which is, I mean, in the grand scheme of things, not bad.
Yeah, especially now.
No, to put it, let's take a typical deal. If it's a 14% cash on cash deal, 8% to the investor, that means you got 6 left over. And if it's a 65-35 split, maybe it's approximately 4 to the investor and 2 to the sponsor. So the investor or the money is getting 12% and the sponsor's getting 2%. Yeah. If you look at it on a cash flow split basis. So that an investor should feel pretty good. That's a good split for the investor, and that's going to really make the sponsor try to exceed the targets, because that's when he starts winning more.
Right. Exactly.
Getting 8%, he doesn't win. He gets nothing.
Yeah.
So he's really motivated to earn you more. That's the only way he can earn more.
Yeah.
He can't earn unless he gets you over the hurdle of 8%.
Yeah. The investors should want the sponsor to be incentivized to do as much as we can. So by getting some of that split on the end, that's our motivation.
Last one I'll throw in: when do they get their money back?
Yeah.
And so there's a couple different ways. First, we can do a refinance. And under our docs, a refinance, a recapital event, we have to pay back 100% of the investor capital first. And only then can we split profit after that. That's a refinance. And on a sale, obviously, 100% of the capital has to go back to the investor. And if we haven't been meeting the 8-pref, we have to bring that 8-pref current. And then after the capital's been paid back and an 8-pref's been paid back, only then do we split on whatever the situation is, 65 to the money, 35 to the sponsor. And that we typically go on a 5-year hold, but we've done longer, and it really just depends on market conditions. And we're constantly evaluating those to make sure we make the best decision for the investor.
Thanks for checking out how to invest in CRE. Make sure to like and subscribe, share if it helped you learn anything, and we will see you next time.
Thanks. Guys.